100. We are live, trading at 637.59. 637.59. Pre-market. Hold up for me. Swing thing over. Okay. Let's break those swing down here. All right. Um, let's see here. I'm putting the link at the top of the room right now for those that don't already have yeah. I'm also going to put it in the chat down below or in the event that you get it in that format as well. Right? Right. Um, I think this is a pretty crazy open. Um, 637.76. Um, we'll talk about why in a few moments. Um, I'm gonna mute my mic over here on Clubhouse. Okay. Keep it open. I'm gonna mute my mic over here on Clubhouse, and we're gonna be talking over there on Twitch. All right, all right. Now, give a few moments here. Moment. I'm just bringing this out. All right. Just sharing out the screen. In the meantime, while I do so, you can feel free to take your channel equity and apply it to the dedicated to learning challenge. Right? If you were to click on the channel points, you'll see the August dedicated to learning challenge, and there you can use your channel equity to apply and you know get some free education and share it with the world. Right? Let's see here. Oh, right, there we go. Frame manager open, and we are good to go. Solid. All right. So, right out the gate, this is a really solid open. Okay. Let's talk about why. Let's talk about why this is a solid open here. Right out the gate, um, 637.74. Right, 637.74. That was our shout out to that Brooklyn for the follow. Shout out to that Brooklyn for the follow. Much appreciated. Um, so 637.74 was our um, that was our first. point of momentum for the day. This is R1 from the daily perspective. All right. Give me 1 second. I'm going to repeat that in a few seconds. Let me just pop open my other. All right. So, yeah, so 637.74 there. And you also have 637.78, right? Let's refresh this here. Then you also have 637.78, which is the other key level that we're looking at here. And above that, 637.88, that is where our, upward trajectory is really, like that's where the base was sitting at, right? Before we started to come back downward. We had a base set at that point. And, as you can see, we're kind of struggling around this area at the moment. But like I said, nonetheless, this is still a pretty, solid open. Now, the question is, can we stay above these key levels? That's the big question there. So, in this first 2 hours of the day, right now, we only got, as we were talking about earlier, we got Jerome Powell coming up at 10 a.m. In these first 2 hours of the day, it's going to be really important to see the market really sustain, above these levels. Now, let's go to the daily chart here. And let's just take a glance of what this could look like in the market today. So, a push higher, could really set the tone for a move back towards your right back towards your previous high here. Right, especially if we can get back above the 641 area. Let's go back over here. Right, this 641 area is not only it's big on the deviation side. It gets us back above some key levels there, right? But it's also your weekly pivot. Now the the market right now, when it comes down to the SPY, your S&P, right? We are actually within range right now of the 20 MA. So that is in and of itself, you know, where part of our struggles are coming from. We're in a consolidation range, meaning this is an area where it's not that hard to get trapped up, and that's to me what happened is we fell back into this area here. So now we're going on our third day in this area, and looking to break out. Like so, we can get above 638.96. Right, we can get above that. Then we're doing some things, right? 638.96. That puts us, um, you know, well enough away from the that puts us well enough away from the 20 period moving average that we can start putting in some work there, right? So that's about a half standard deviation off of the 20 MA. Now, I'm going to start checking right now. Let's take a quick glance at these options contracts real quick. All right, take a glance at these options contracts. Give me 1 second here. I'm going to go look at some options contracts for the VIX is what I'm about to look for. I'm going to look at options contracts for the VIX. All right. Remember, we're looking to see how far does the market have to push. All right. How far does the market have to push in order to um, how far does the market have to push um, in order to give us the price we're looking for on those January VIX positions, right? Let's see here. Um, we still got some work to put in here. All right. In order to get to that level that we're really looking for. That 55 is looking enticing, but we're gonna wait till the market pushes enough to 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 really lock in that a 50 strike at a better price. Okay, that's what we're looking for. But you can see that 50 strike is definitely in demand. You know, to tell for sure. But um, if we don't get the 50 strike for January today, I might be looking at the 47.50 strike for December. We'll see about it. We will certainly see about it. So let's just keep our eyes peeled on this, and the box gonna bring our way. Um, So it's a pretty. Look at this. Look at the spy. The spy actually, you know, putting in some numbers today. Look at the Nasdaq. We've been talking about this. The Nasdaq's been having some struggles, right? When the Nasdaq starts lagging the market, this is a point of dispersion. This isn't typical, right? This isn't typical. So you you're certainly looking to figure out like what's going on there, right? Why am I why am I seeing the Nasdaq? Um, why am I seeing the Nasdaq underperforming all indexes on a day like today? Right. Let's see how this works, man. Again, we're so now we're above that trajectory point. We want to close above this, right? We want to get a close above this, through to 11:30. We get a close above that. That's going to be a good look for us. Okay, so close above this. Uh, as a matter of fact, hey, if we can just pull away now, that'd be even better, right? We just pull away down, that'd be even better. And this to me, so remember I told you guys before, like charts don't have to be neat. Charts don't have to be neat. So people always feel like charts have to be neat. This, in my opinion, is still a morning star. I mean, right? It's still a morning star right here, right? We just had this, this extra wick down here, you know, that most people look at and say, "Oh, that's not really a morning star, though." Right? Let me show you guys a morning star. Show you guys a morning star, right? All right. There's a morning star right there. Okay, there's a morning star. So to me, yeah, first candle's red, third candle, open the gap. Second candle opens the gap. Third candle opens the gap. You know, and then kind of gap back up from there. Right. You're closing above 50% of the first candle on this one. So which I think you'll likely get. So, as long as you're closing up in this area. So well, you guys are 50% of the way done with the dedicated to learning challenge. Okay? You're 50% of the way done with the dedicated to learning challenge. right? That's good stuff. That is good. Uh, Watching out, and so remember, right? We we exited down here. We exited down here. In anticipation for this move higher that's happening right now, right? Mainly because we remained above this 632.74 level. So let's keep that in mind. Uh-oh, hold on.
So how long do you think you can sustain margins here if these reserves do not change? You mentioned the holidays. Is that when this starts to kick in? Yeah, we're hanging by our fingernails right now. We can't do this for and with Trump's tariff deals and everything will work them. Notice that or
Um, so that was a grocery store owner talking about how Trump's tariffs are raising grocery bills. Right? And this guy owns a grocery store, and he's saying, "Hey, we're hanging on by our fingernails." Um, he was basically saying that they're about to raise prices, um, and I guess it's going to happen around holiday. So they're trying different things. They're trying to package things in different ways to be sure that they can still give people quality, at good prices. But uh, yeah, it's not always going to work out that well. Um, you can tell this. You can tell this. I think you at 16 Delta. 15, 14, you can just tell this this January $50, not $50 but 50 point strike on VIX. You can tell there's just so much more demand for it today than there was yesterday. Um, even if it's just the slightest amount. No, I think it's probably the demand that came in from yesterday because they're now at 26,000 contracts open at that 50 strike. Yeah, 26,000 contracts open now at that 50 point strike. Very interesting. Um, so here's what we're gonna do. In fact, so instead of getting the instead of getting the because this conference is about to come up. Um, instead of getting the 50 strike for January, right? Because remember, the goal is to put back in what you took out at the lows here, right? Repeat, the goal is to put back in what you took out at the lows here. So instead of getting the 50 strike for January, we're going to get the 55 strike for February, which has 86,000 contracts open, right? I'm sorry, no, 83.4 thousand contracts open. So I'm going to pick up the 55 strike for February. That's what I'm going to end up doing here. What my order is in. I'm going to pick up the 55 strike for February ahead of these conversations here. And what's crazy is well, no, my orders are just in. It's not going through yet. Yeah, I'm doing it right now, but yeah. So I just put my orders in. The craziest thing is, um, like as like right now, this very minute, you can tell demand is picking up for it because the price is still going up, even though um the price is still going up, even though the what do you call it? The price is still going up, even though the SPY is rising at the same time, right? So you can tell there's demand for hedging at the moment. See the spread. You can see the spread just tightened as well. If you're looking at it closely, you can see that the spread just tightened on it. Okay, so I got mine open. Yeah, 55 for February. The VIX 55 for February, guys. The VIX 55 for February. Shout out to Real. Shout out to Alvin for the gifted sub. Um, we got D Black. We got Darrell. All right, gotcha. Hey, look. Um, I be doing my little workouts while I'm on mute sometimes, man. Um, so handle your business, man. All right. Yeah, look at that. See, and this decisions, man. Decisions, man. Okay. So, um, we why were we trying to get in there just ahead of this 10 a.m. speech that was coming up? Because there was no telling how the market was going to respond to that, right? And I mean, how often do we do things right in the nick of time, right? If we talk about when this downside started to happen, we pulled out of that VIX right in time, right around here, right? And then this morning, here we are, right at the highs of the day. Just in time, we decide you know, to grab that VIX. You know, um, I think it's just imperative, man. That we understand. You don't have to be perfect all the time, but if you pay attention and you keep working on understanding the market, you know um a lot of times you make some right on time decisions, Um, so it's not a matter of like just like, nobody can tell the future, man. Right? Nobody can tell the future, but at the end of the day, watching the market push higher like that, you know, um, and cool, that gave us an opportunity to prepare. Look, 10 a.m. just hit. You get your night. Look. Look at your spike here, right? So this is all volatility starting to pick up. Now, if you guys pay attention, your 55 strike just shot through the roof, right? For no reason. And that's what I'm saying. Okay, y'all saw that, right? Like when that first happened, your 55 strike actually shot up, right? Um, so this is where the volatility starts to begin. Powell, shifting balance of risks may warrant adjusting policy. Hold up. How is he? How is he talking already? Hold on now. Hold up. 1 second here. How's he talking already?
The Fed chairman says the inflation outlook is that it will rise, but perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising. The S&P 500 now up 1.3%. Yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
They do anticipate that tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking at these as one-time price adjustments within each sector. So it's likely that inflation is going to go up, but then they think it stabilizes and might go down again.
Well, right now, let's take a listen to Jay Powell, chair of the Federal Reserve.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage-price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the make-up strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
That was Fed Chair Jerome Powell wrapping up his annual Jackson Hole remarks. What a Jackson Hole speech that was. This is Bloomberg Surveillance on television and radio, live from Jackson Hole, Wyoming. What we heard there is they are prepared to move rates lower on the heels of their dual mandate being in conflict. We see a market reaction. We could see 10-year yields are lower by 10 basis points. Two-year yields are down by 10 basis points. So, 10-year yields are down by 7 basis points. What you see is a weaker dollar, stronger euro by some 0.7%, which you can see the dollar just weakening across the board, and you can see that increase on the equity space. We have been getting some other news. President Trump has been tweeting saying that if Lisa Cook, Fed governor, doesn't resign, he will fire her. There also was some drama in the main hall of the Jackson Lake Lodge. Bloomberg's Michael McKee is with us. Mike, can you give us a picture of what's been going on as Jay Powell was speaking?
Well, it was, I guess, shortly before he spoke, Lisa Cook walked into the Jackson Lake Lodge. She was not here last night. I guess she's just arrived. And James Fishback, who runs Zora Capital, he sued the Fed in court trying to get the Fed to open its meetings to the public, and the court threw that out. But he was standing there and started shouting at her, "Why did you commit mortgage fraud?" He was apparently, according to the Bloomberg reporters who were there, escorted out by sheriff's deputies.
Yeah.
I think we have to be clear here that these are allegations at the
Absolutely.
best, that there are no charges, no processes in place at this time, right?
No process is in place at this time, and what we've seen from Bill Pulte from the Federal Housing Finance Administration and from the president are they're trying to say factually that she committed fraud, and there is no evidence of that yet.
We will discuss that at a later point. Right now, we're just still digesting the text of a 40 to 45-minute speech by Jerome Powell. It really compares to the 8-minute speech back in 2022. There will be pain. This is a complicated moment. The market sees it as maybe a little less complicated, and to really digest what we just heard, Citi Wealth Chief Investment Officer Kate Moore, who's on set with us in her beloved Jackson Hole, Wyoming. And Kate, what's your impression? I mean, how much did what we just hear from Fed Chair Jay Powell change your view of what their reaction function is going to be?
So it hasn't really changed my view. What I will say is in the last couple weeks and talking to other people on the buy side and really getting a sense for investors, people were moving a little bit more towards the 50-50 in September, even if that's not what was getting priced into the market. There was the sense that this tension between the labor market and inflation was going to make the decision really difficult. And I think what we're hearing this morning is that, the Fed is on path to start easing rates again or proceed with the cycle. But I don't think that the rest of the meetings to the end of this year and through 2026 are done deals yet. So much is going to be data dependent. So I see the market price moves, and now with near certainty for September and on through the balance of the year. And I think we just have to watch the data.
Right. In watching the data in the Heritage of Citigroup economics is Willem Bouter, Catherine Mann out the Bank of England and all. There's a complete international and holistic view. Is this ginormous, that's a fancy word, CFA word, folks, this ginormous investment that we're seeing in AI, is the certitudes of this summer, are they at risk given the tumult?
Well, Tom, you point out something. The market's been really crowded. Most investor segments have been crowded around these secular themes. And for good reason, right? These companies are putting up great numbers. Every company across every industry is investing in AI and technology. So if you had uncertainty around policy or economic growth or geopolitical tensions or international relations or, fractures in the U.S. consumer, everyone was crowded in this space. That said, they're not crowded because these are companies with, they're crowded because these companies have great fundamentals and the path forward looks great. But what we'll have to see as we go into the back end of the year, if we get okay growth numbers, or if we get inflation that's a little bit too perky, if we get rotations in the market. I think some of the rotations in August into the small cap was unwarranted in my view.
So we are sitting here after digesting that speech, and I'm going to have to go read it about 3 more times to really internalize all of the complicated messages laid out by Jerome Powell in his last speech as Fed chair. Mike, before we continue, Michael McKee here, our chief economics correspondent, can you just wrap through some of the key headlines once more so that we can really understand just how big of a policy shift in some ways this really was?
Well, it's a policy shift, but one that has been signaled for a little while, which is why the markets have been buying into it. But Powell basically accepted the market's argument that it looks like the labor market is weakening, and that is a threat to the overall economy. And inflation is rising, but it may not rise as quickly as the Fed had feared. And so therefore the door is open to a rate cut if we get supportive data from the CPI and the employment report that we get at the beginning of September. Now, the thing about what he said today that I think is important is once you open the door like that as Fed chair, it's almost impossible to close it. It would take a lot in these data points that are coming out to change that view. And the market's going to go overwhelmingly towards the idea of a rate cut. So he's pretty much baked it in at this point. So I think what then happens is it goes to Kate's point about where we go from there. The focus will be on the other two meetings this year and then what you do into 2026. And I think if you asked the chairman, he would say, we don't know yet. That's the data dependent part. But for right now, we're going to give you what you think you need.
And right now, what you are seeing is almost a certainty priced in for a rate cut next month. But Kate, one other thing you're seeing is weakness in the dollar on the heels of this.
Yeah.
Do you expect that to be very much an ongoing theme, and it just kind of edifies it, given that this is taking the more dovish approach?
Yeah, you know, we had a pause in terms of the weakening of the dollar after a really vicious weakening in the first part of this year. And I've heard a lot of currency strategists say, you know, we're going to tread water for a little bit. We've made a lot of the adjustment. But if the market really believes with high conviction that we're going to continue on a rate cutting cycle, you know, I think it's fair to assume that the dollar would weaken a little bit. I think most people would say over the longer term, they agree that the dollar has been overvalued for a considerable period of time. And I expect that we'll see a little bit more of that adjustment. On balance, though, I think we're going to see, you know, appreciation in some U.S. assets, particularly the U.S. equity space, even as the dollar weakens a little bit. And I'm hedging some of the stuff and some of the concerns I have in the portfolio around uncertainty and perhaps pick up in volatility in September into the beginning of October with a little bit of gold.
Interesting. We'll catch up with Kate Moore. She's going to be sticking with us, Citi Wealth Chief Investment Officer, as we get through all the headlines and get some commentary. Joining us now is someone who is very familiar with these types of speeches, St. Louis Fed President James Bullard, who recently was in the media talking about his preference for 100 basis points of rate cuts this year heading into 2026. Also a potential contender, I should say, to be the next Fed chair. Jim, how much are you seeing what we heard from Fed Chair Jay Powell and seeing anything different that you would really say if you were at that podium?
He used the speech to solidify expectations for 25 basis points in September. I was expecting that anyway. Markets were expecting that. He leaned into the most recent labor market report, which was very soft, and so I think that's a done deal. He didn't say too much about beyond that what you want to do with the October meeting or the December meeting. I have said 100 basis points, going into 2026. I think you could adjust as you go forward and eventually get a full 100 basis points, but I would go slowly in order to watch the data. And then on the framework review, I'm sure much earlier in the year, they had targeted that they would have the framework discussion and that they would use the Jackson Hole speech to talk about changes to the framework. I thought those were thoughtful and they were well presented in this speech, and they're about what many have speculated on. So I think they did about as much as they can on the framework side.
I don't know. I just can't talk to you. Jim Bullard, Tom Keenan, good morning to you. I definitely consider this my conversation of the day. You served a lengthy term at the St. Louis Fed. You have lived the decline of a greater economy decades and decades ago in the effort to provide for a resurgent St. Louis. As the next chairman of the Fed, whoever that may be, do they have to manage for two American economies, a technology-driven, exceptional economy, and another, to use a cliche, America flat on their back? How would a chairman execute those two Americas?
Just everything all the way around.
Yeah, I think income and wealth distribution have become more salient topics for the Fed. It's not that clear how much the Fed can really do, providing interest rate policy for the whole economy. If you change the rate structure, that affects everyone, not just one particular group that you might be targeting. So I think that's been something we've had to wrestle with, and I've actually done research on it myself to try to understand it better from my point of view. So I think this has been a theme for a while, and that'll be an important theme in macroeconomics going forward.
Mike McKee's got a lot of smarter questions than me on the immediacy of this speech. I'm going to ask one more distant question, Jim Bullard. You're at Purdue executing online technology education every single day. How do you define the new technology productivity that America faces? Is it enough to save us? Is it enough to really add on to our present GDP?
Oh, yeah, I think that the AI boom is, it's a general purpose technology that will diffuse through the economy. I think the key question is how fast does that actually diffuse? And sometimes markets can get ahead of themselves and think it's going to happen sooner. Sometimes they're too late, and it happens faster than markets think. But nevertheless, any way you look at it, it's an important technology. It can drive productivity. And I think in higher education is one of the places where you can really have the biggest impact. We put a AI requirement in at the Daniels School here for every single student, and we're trying to expand that to all of Purdue. So I think that just shows you how important this technology is.
Jim, it's Mike McKee. I have a question about sort of the process involved in this speech. The chairman is giving his own speech, but basically when he says it's time to maybe adjust policy, he's speaking for the entire Open Market Committee. Going into a speech like this, would he have polled everybody? Does he think he has the votes for that? Because we've been speaking with Fed officials here in Jackson Hole, and there are still some who are saying, well, we're not sure that we need to do that yet.
Yeah, he's going to report on the center of gravity of the committee, even though there might be people that have misgivings. At the June meeting, the committee had a median dot plot of 2 rate reductions by the end of the year. And I think the minutes suggested something that was more like 50-50, but then the labor market report came in. I think that tilted the balance. So he could have pushed back a little bit. I think financial markets were expecting him to be a little bit more hawkish here and try to set up a 50-50 meeting where you would wait and see for the rest of the data to come in. But I don't think that's where the center of gravity is on the committee. So he went ahead and leaned in. I thought there was quite a bit of talk about the labor market at the beginning. You could have been a little more emphasis on the low unemployment rate, for instance. And he did come out at the end of that discussion saying, well, it's in balance, but we're a little bit nervous. So I think I think he's accurately describing where the bulk of the committee is.
Well, where would you be on this question? Because we've heard Fed officials for some time now saying, yes, we had poor job creation in recent months, but the unemployment rate, as you just mentioned, has been low. And they've described the labor market as solid. Now, this seems to be sort of a major shift in the way they view the outlook and the sort of balance between the two mandates.
Yeah, what he did at the end of that discussion, he said, well, it's in balance. But I think the committee's nervous. I think it has been slowing. And I think the policy rate is moderately restrictive. It's maybe, 125 basis points above the neutral rate. Is that really where you want to be in this circumstance? I think the answer is no. So you can come down some and still have moderately restrictive monetary policy that puts gentle downward pressure on inflation. And then the other thing I think has happened is that this argument from Chris Waller and others on the committee that the you should look through the one-time increase in goods prices coming from tariffs. I think that's carrying the day. And, then he emphasized that inflation expectations remain anchored and so on. And so I think that sets up a modest move downward in September.
Jim, we've been talking with you for years, and you are very focused on the discipline of economics. Right now, I'm looking at the headlines that are crossing from the past hour. The top one, of course, is Jerome Powell, Fed chair, saying that shifting risks may warrant adjusting rates. The second one is that Trump says that he'll fire the Fed's Lisa's Cook if she doesn't resign. As someone who is thought to be a contender to become the next Fed chair, Jim, how much does it concern you that there's this increasing political noise around the seat and exactly what the path of policy forward looks like?
Yeah, I want to see due process around something like this. I want to see, you can make charges against anybody about anything, I guess, and, the person can answer the charges and the DOJ can decide what they want to do and so on. So I think this has should have longer to play out before you took that step. Otherwise, it's just is kind of the Wild West, and should you get reinstated later, I guess, or something if there wasn't a conviction. So it seems messy to me. I think these kinds of charges are made from time to time against various officials around Washington, but I'd like to see due process there.
Jim, there's another question here, and aside from Governor Cook and what happens there, about how the perception of political interference handles the market reaction to Fed policy. There is this perception that could cause the dollar to weaken more because there is more of an emphasis on supporting growth and supporting the labor market than containing inflation. And some people are worried that if the Fed does cut by 50, 75, 100 basis points, as you were talking about this past week, that you could see a move up in long-end yields akin to what we saw last year. If you are on the Fed currently and you did see yields along the long end moving up in response to near-term Fed rate cuts, what would you do?
Well, that would definitely be a concern, and that's the tricky part of this business is that, you think you're pursuing a dovish policy at the short end, but the long end goes up because inflation expectations start to rise, markets start to lose confidence in the Fed and the credibility of the Fed, and that can go very, very badly and unfortunately fairly quickly. So I think you do have to be careful here. But I'm saying that I think the committee has room to maneuver if they proceed carefully over the remainder of 25 and the first half of 2026.
I don't want to get out front of the debate here or the moment, Jim Bullard, but what I would say to Chairman Bullard and Mike McKee, I got to turn to you. You and I used to sit and look at the dots and go, which one is Bullard? I mean, you and I have done
it's fairly easy after a while to figure out. I know Jim would probably agree with that.
Chairman Bullard, is your first act, if you take over the Fed, is your first act to get rid of the dots?
Yeah, I've threatened to, as president, I threatened to withdraw from the dot plot. I think this could be done better. This was discussed at the Framework Conference, and former Chair Bernanke gave a very nice presentation and talk about a quarterly monetary policy report, get more organized about it, put out a forecast. I think all of that could be done. I've advocated that for a long time. And so I think that would sort of clear up some of the misconceptions around the dot plot.
Okay, this is really, really important, folks. As Jim Bullard made economic history, I would say a decade ago, with a small, short paper, forceful on regime change. How do we get a new Fed away from the guessing and the certitude and the silly parlor game of it, Jim Bullard? With great respect, how do we get to that more disciplined study around the game of the Fed and regime change?
Yeah, I think regime switching is a great way to think about the global economy and the U.S. economy and how it operates. There are relatively long periods of time where you might have, let's say, slow growth and very low interest rates, and then you might switch to another time with faster growth and higher interest rates. I think understanding that and understanding how that affects policy choices is a great thing to study further and talk about further in the years ahead. So, I think it's very salient for what the committee does.
Jim Bullard, former Fed president of the St. Louis Bank, will be sticking with us right now in markets. You can see a cheering across Wall Street to the opening the door to a potential rate cut next month, and potentially more. You could see equities surging higher across the different indexes, led by some of the more interest rate sensitive sectors, the Russell 2000. You can see 10-year yields down now about 6 basis points, even more at the front end, down 10 basis points. As people look to the prospect of the Fed looking through some of the inflation from tariffs. You could see the dollar markedly weaker, 117 on the euro-dollar cross, up 0.9% in terms of just the percentage rise, up about a basis point. And there's a real question here about what this means going forward. Citi Wealth Chief Investment Officer Kate Moore is still with us, freezing a little bit because it is a little bit chilly here, nippy in the morning. I am curious, though, about what you're hearing in terms of prospective Fed chairs and the politicization of the Federal Reserve. If this is a Fed willing to err on the dovish side, does that mean something that materially is higher with respect to returns and with respect to risk appetite?
Look, markets love certainty, and our investors love certainty, and we want a certainty in terms of the process around making monetary policy decisions. So I don't have any insight into who might be named next Fed chair, but what I will say is if there is a sense that the process is changing, I think that will lead to some pause and perhaps some volatility in the market. Our expectation is that regardless of who takes the next chair and what seats are filled, we'll have a continuation of the process of being data dependent, of being thoughtful, of having great debate and discussion amongst the Fed governors and their staff. But if that were to change, I think that would introduce volatility. I think the most important thing for us right now is to recognize that so much of the data is going to be mixed through the back half of the year, and that's going to have a huge impact, I think, in terms of investor sentiment, and I would suggest even more crowding in some of the favored trades.
We tend to get reactions like we're seeing in the market now on a day when news breaks, but I think we're probably going to see extended rally here because people are anticipating this rate cut. Does that worry you in terms of a bubble forming or some sort of excess spending that would push up inflation because of inflated asset prices?
Yeah, so I have been a little bit worried actually about positioning. I feel like I've been a little bit more cautious, frankly, than some of my peers on the street, and saying, people own the highest quality parts of the market. It's quite crowded. Some of the shorts, when we're looking at some of the fast money community, are very similar across the board. And we've seen people kind of shrug off concerns around economic growth or even the technological disruption across a lot of industries. We've seen significant improvements in terms of the earnings or vision ratios. Citi Economic Surprise Index has moved up, and all of this together, I think, sets us up for, a little bit of weakness if there was a bad data point or if there was a bit of a shock. There's a lot of consensus positioning.
Well, Jim Bullard, I'd love to bring you back in here. How much does that concern you, that sort of a bias to cut rates could cause asset price inflation to get ahead maybe of where the economy is?
Yeah, equities, except for just recently, equities have been doing very well as they've digested the new trade policy of the U.S. and how that's going to play out globally. You've got the AI boom going on, really driver for the big tech companies, and I do get concerned that we get ahead of ourselves. Sure, it's a great technology and everything, but how fast is it really going to diffuse into actual productivity in the economy? But overall, I would say it's possible that we'll get higher productivity growth ahead and really a good outcome for the second half of the 2020s here, much as we had in the second half of the 1990s.
right? Let me talk to the chief investment strategist, Purdue University, right now. I'm going to do a double-barrel question, first to Dr. Bullard and then to Dr. Moore. Jim Bullard, as simple as I can, all of my conversations, whether Joachim Nagel, Bundesbank, Kate Moore, Citigroup, and on, is about an elevated or persistent nominal GDP. Do you frame out that we're going to have an animal spirit in the country, whether it's better real growth, okay inflation, too much inflation, okay real growth, but what we're talking about forward is an elevated nominal GDP?
If you think real growth is going to be faster, then yes, nominal GDP growth would be faster, even if the Fed hits its 2% inflation target over that period. So, yeah, you would see higher, faster nominal GDP growth.
I mean, I look at this, Kate Moore, and it's a heart of the matter. I'm really surprised by your comments. I think they're extremely important here, back to U.S. quality, et cetera. But it sounds like Citigroup is modeling out through all the emotion, the fear, the turmoil, the political debate, as we just saw next to the 8-foot bear in the lobby. The answer here is you're modeling out that we'll be okay and there'll be a better nominal GDP. It leads into revenue, et cetera.
Look, I think we're going to have an okay growth environment. But one thing we keep on talking about is sort of the K-shape, right? There are the haves and have-nots across all the different industries, different consumer groups. And so I don't think that we want to assume that everyone is going to experience strong growth in the second half of the year. Yeah. And we're seeing this, of course, in the consumer companies. We're seeing this across, segments of different households. We're seeing this even in technology companies, those that have made the investments and are reaping dividends from it. So, yes, we may have these good headline numbers, but I think as investors, we have to really pay attention to what's going on beneath the surface. And I think there's an opportunity for differentiation over the next couple quarters.
We are looking at a market that is moving. We are looking at headlines that are coming. And I want to bring this to you, that Canada is planning to remove retaliatory tariffs on many U.S. products in an olive branch to President Trump. And there is this feeling that maybe some of the tariffs are fungible, that we are going to see some of them removed or used as a negotiating stick.
I strongly agree with what you're saying. This was sort of out there in the ether last night, but to see these headlines is another example. We adjust.
Well, and that's one of the reasons why there has been a focus on the labor market. Fed Chair Jerome Powell speaking just moments ago, really focusing on the complications for the labor market.
Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment.
Some people might say that Fed Chair Jay Powell is coming around to the Chris Waller view of things, that there is this feeling of potentially the weakening in the labor market taking priority over inflation at a time where some of these tariffs are put on, taken off, and that's what we're seeing a little bit in terms of negotiation this morning.
Well, the give and the take, and it goes back to Kate Moore's optimism on investment in America, and you see it in dollar. Thank you, New York, for putting up that wonderful dollar loonie chart, and you see things adjust, and you wonder, okay, what do we do with China? What do we do with Mexico, with the produce debate, and pharmaceuticals with Europe? Guess what? There may be constructive surprises as the certitude of the tariff debate gives way. It makes it easier for the next chairman, and maybe I'll get out of triple leveraged all cash. It's 50-50.
Oh, now is the time to definitely do it. Yeah, for sure. Jim, before we let you get on with your day, I do want to finish there. That have we seen from tariffs that there is this fungibility there, that they get put on, they get taken off, and that right now the path of travel is lower from where we were maybe on April 2nd, not higher again. And so you can look through in another kind of way some of the inflationary impact.
Yeah, I mean, I think it was great to reach a preliminary deal with the EU. That's one of the bigger blocs in the world. China put on the back burner markets like that for now. And then you've got Canada and Mexico. It looks like we're headed toward renegotiation of the USMCA, which I think would be a fine thing to revisit. Was scheduled for 2026 anyway. So it's it's maybe a little bit more settled than it was earlier this year, and I think markets are liking that. That's making it easier to plan. So so far so good on that.
Jim Bullard, former St. Louis Fed president, joining us. Thank you so much for being with us. Maybe future Fed chair, we shall see. The process is ongoing. And Citi Wealth Chief Investment Officer Kate Moore, before we let you go, I just would like your take on this, the idea that we are at a moment where suddenly people are looking through the inflationary ramifications of tariffs. Are you seeing the same kind of thing? And that's appropriate. That this isn't 1970s. This is a different shock that usually is a demand shock in the end.
Look, I will say people have been looking through the inflationary impact of tariffs for the entirety of the summer at this point. There's been an enormous roller coaster ride in terms of expectations for end tariffs. But what I will say is this, even if we're at a lower rate, I'm just going to say 15% effective tariffs relative to where expectations were in the beginning of April, I think we have to keep our eye on the sectoral tariffs. And this has potentially some of the biggest impact for overall earnings. And those are sticky, we know, and are likely to endure through multiple different administrations. So, this give and take between some of our trading partners around the reciprocal tariffs, we're watching that. It's very hard to trade around it. But I will say the sectoral tariffs are going to be very important for our outlook.
Kate Moore, you've been incredibly generous with your time. Thank you so much for being with us here. Yep. We will see you in New York. Citi Wealth Chief Investment Officer Kate Moore. If you are just joining us, we did hear from Fed Chair Jay Powell. He said that this actually is a time where potentially they could start to look to the shifting policy dual mandate, and what could eventually come would be a rate cut in September. Mike, it seems like that's what the market is pricing in. That's what the market's pricing in, and I'm fairly certain that's what Chair Powell is referring to. But because we're fair and balanced, I have to point out that Carl Weinberg has messaged from High Frequency Economics and said the chair didn't say cut, he said adjust, which means they could raise rates as well. Probably not in September, though. Yeah, I don't know. I'm not thinking that that's actually at all what he meant. What do you think, Tom?
I think it'll be great to speak to the former vice chairman here as well. Within what we heard there from Jim Bullard and from Kate Moore, Mike McKee, to me, what is so interesting here is the outcome of the tariff debate. And the answer is we simply don't know. Today, it's Canada. Monday, it will be someone else.
Well, here's the thing. Tariffs are bringing in a lot of money right now. It's not that the other countries are paying it. We're all paying it because it's a tax on basically the consumer in the importing country. But what the administration seems to have done is made up for the deficit we're going to get from the big, beautiful bill by raising everyone's taxes and not telling them that their taxes are going up. So people are accepting it, which may mean, as Bloomberg Intelligence is putting out in a story today, that those don't go away, that we get used to this higher price level and get used to tariffs, and they stick around because they do add revenue. It's coming out of our pockets, but they do add revenue to the government. So what's the end game? If this is working and adding money to the Treasury's coffers, then this president could use them in many different ways, many different times to increase revenue. So I think that we're going to be living with this for a while, and the uncertainty it brings for a while.
Well, let's take a listen to what Fed Chair Jerome Powell had to say about tariffs and what the impact is on the economy. Take a listen.
The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem.
What you can see is the response is rip-roaring in markets, with equities surging, yields plunging on the front end, yield curve steepening, and a dollar weaker. PIMCO Global Economic Advisor and former Fed Vice Chair Rich Clarida joining us now. And Rich, what's your take on what we just heard from Fed Chair Jay Powell?
Well, I think the chair certainly intended to open the door pretty wide to cutting in September. Importantly, Lisa, he spent a lot of time on balance of risk, which is what policymakers do. But at the two key junctures, he highlighted that the balance of risk to the labor market is to a weaker labor market. And he basically indicated that the balance of risk to higher inflation doesn't appear to be a first order concern in terms of persistent inflation. So I think the message was, They think they're going to cut in September. We get some more data, and the markets have reacted to that.
How much do you think that this is partly to maintain the Fed's credibility, not necessarily with respect to the president, but that right now, if they get it wrong on the labor market front, that it is that much more pernicious based on some of the jawboning by what we hear from the president?
Well, yeah. I mean, as the chair said in the remarks, it's a curious kind of balance in the labor market. The payroll employment growth has been very, very weak in the private sector, but the unemployment rate has not gone up. And so they are really focused on the balance of risk. Look, the Fed has a dual mandate. It's costly to let inflation move higher and stay there, but it's also costly to have a recession with the rise in the unemployment. And I think, Lisa, you're correct. They are tilting in that direction now.
It feels like a very different Jackson Hole, and this is something that we've been talking about with all of our guests today, Rich, that people have come on and said there is a different tone about central banking independence and a question of how to communicate at a time of such political interference. What's your sense of where that was in the speech that we just heard from Fed Chair Jay Powell?
I think the approach the chair took was to really focus front and center, Lisa, on the dual mandate. That's assigned by Congress, maximum employment and price stability. And the chair gave a very reasoned and thoughtful analysis and discussion of how they're balancing the dual mandate risks. And I think that's the Jay Powell message to the issue of Fed independence. We have an assignment from Congress, and this is what we're doing to achieve it.
At this point, we also are dealing with the headlines that are coming out about Fed Governor Lisa Cook, where at the same time that Jerome Powell was giving his speech, President Trump came out with this truth post saying that he will fire Lisa Cook if she doesn't resign. We did hear reports that in the Jackson Lake Lodge in the lobby, that James Fishback was screaming at Lisa Cook that why did she commit mortgage fraud? What's your take on what this does in terms of both the Fed composition, but also just the ability to be clear-minded about making Fed policy?
Well, obviously, understand, just looking at the headlines that you mentioned myself, and don't know the details or the facts in this particular situation. But clearly, we're in an environment where Fed independence is under scrutiny. And my conviction is that, notwithstanding all of the very relevant factors that you mentioned, that the Fed's is going to keep doing its job.
Richard Clarida, Tom Keene here. Thank you so much for joining us. Very valuable. I've got two tasks I want to take here that I think are important. You recently said that what matters is the institution, that this chairman and any future chairman has to protect the institution. What's the day one first mandate to protect the institution for the next chairman?
Well, I think first and foremost, it's to have in place a plan and communication that will deliver expectations of price stability. I think the chair was right today to emphasize that the Fed has to focus on getting price stability because that's going to deliver the ability to deliver maximum employment. Right. I've also written, Tom, that the Fed is sort of a complex and cumbersome institution with 19 folks around the table and the Reserve Bank presidents, but I do think that is a strength right now of the institution.
Right. Well, this is really important because it's as fractious as a meeting of the bond team at PIMCO. In the middle of the speech, Powell channeled a few years ago at PIMCO the new normal. For a moment, I thought Mohammed Al-Arian had parachuted in to write the speech. What is your optimal new normal for the Fed, which Powell mentioned today? What's the best new normal for the next Fed?
Well, I think a new normal would be inflation moving down towards the 2% target, which would let the next Fed chair cut rates down towards a neutral level. You know, PIMCO in 2014, we rolled out the idea of a new neutral, and we've been operating in that new neutral world now for more than a decade. And so I think well-anchored inflation expectations, getting tariffs in the rearview mirror would allow the Fed to cut rates by probably 150 basis points from here, and achieving that ultimate soft landing. So I think that would be a good new normal destination for the next Fed chair.
What risks are there to that, given what we're seeing with the dollar, given the fact that we really have a very high level of uncertainty around which tariffs are going to stick and how much is going to get passed along to consumers?
Sure, and I think the chair was right to point out that we are seeing evidence of tariffs showing up in the price indexes for imported goods, but that's been offset to some extent with a decline in services inflation. Again, I think where they are focused is to make sure that what is an inevitable increase in the price level from tariffs does not over time result in persistent inflation. And I think the speech today addressed their thinking right now, which is that their baseline is that will not happen, which will give them the room possibly in September to cut rates.
Yeah, Lisa, I think it's important to mention within the market check that the market is putting on steam here an hour after the beginning of the speech, and Mike McKee's bombshell headlines, the Dow lifting up. I'm not told I can't leave Jackson Hole unless Dow goes up 1,000 points. Well, I'm getting pretty close to it.
It sounds like you're going to be hiking for maybe another 6 hours, and then all of a sudden not so much. Rich, I do want to know, though, about what this does in terms of the currency ramifications and where your preference lies in terms of the good investment backdrop, because what we heard from Fed Chair Jay Powell was so vastly different from what we heard from Joachim Nagel of the German central bank, where he said we have to focus on inflation, and right now that is more concerning to them than trying to support growth by cutting rates or being stimulative. The fact that that is the framework there and it is such a different framework here, does that make you want to invest in Europe a little bit more?
Well, I think one of our themes at PIMCO is that we're in a world where taking advantage of a global opportunity set makes sense. Also, we're in a world where it makes sense to focus on valuations. And without getting into particular markets or securities, there have been some pretty big divergences between valuation in the U.S. and Europe, especially in equity markets. Also, the Europeans are much closer to their 2% target than is the Fed, because from the Europe point of view, the tariffs are really a disinflationary force. So we're at different points in the rate cycle, and that does open up some good opportunities.
Richard Clarida, you are definitive in the mathematics, the modern mathematics of our economics. Then, we talk about a new framework, and it's a lot of jawboning about process. Maybe it's what are we going to do with the dots? What are we going to do with the mathematics of modern economics forward? Is it diminished after all this turmoil?
Tom, you and I over the years, decades now, have talked about that a number of times, and my thinking continues to be the mathematics, the models, including my own, are tools. They're a starting point for analysis and discussion, but they're not handcuffs, nor are they the destination. And certainly, the last 5 years have been unusual with a pandemic and all the rest. But I continue to believe that models and math are tools, not handcuffs.
My goal right now, Rich, is to get you on the short list is to be the next chairman. So let's talk tariffs here. What is the Clarida mathematics of Trump tariffs?
Well, as Mike McKee said, they are raising a heck of a lot of revenue, and I would agree with Mike.
There you go. I
think Washington may very quickly get hooked on the $200 or $300 billion a year in tariff revenue, especially if the initial cost of raising that revenue is in the rearview mirror, which I think I expect to be the case down the road. Look, we're in a different regime. We talked at PIMCO in June about an era of fragmentation, and these trends have been accelerating, and the destination for the global trading system and global economy is going to be very different in 5 years than it was in the 30 years of globalization. So I think to be continued is the way I would answer your question.
He's running? Is that what you think?
I don't know if he's running. I know Bullitt's running.
Yeah.
I think by the time we get done with the show today, we're going to have Tracy Alloway running.
I think that maybe. We'll find out in just a hot second. But I am.
Yeah.
We will. She's sitting here with us. I'm sure she says hi back. Rich, I am curious, though, going forward, this idea of how inflationary tariffs could or couldn't be, given the fact that this is a new world order. And we were talking with Adam Posen of the Peterson Institute earlier, and he was talking about how he sees inflation as having nodes of the 1970s and potentially being really pernicious. Why do you not necessarily see that? Why are markets more sanguine on that risk?
Well, I think simply because the 1970s were a very serious experience for the current group of policymakers who lived through it. And I think there were some important lessons learned. And one lesson learned is high and persistent inflation is very costly to the economy. And I think politicians learned that as well. And so I think that central banks have earned a lot of credibility under Volcker, under Greenspan, under past Fed chairs in the U.S. and abroad. And I think that expectations of inflation, we're sort of in a world in which the bond markets at least think that over a 5-year period, the Fed is going to do whatever it takes to get inflation down to what I call 2 point something. And I think that's an important victory that central banks are still benefiting from. And I would expect that and certainly hope that will continue.
Richard Clarida with us. For all of you on radio and TV, we've extended this wonderful show with the huge market move we see today off of the Powell speech. I want to turn to Michael McKee because my head's spinning. I've got Chairman Bullard, Chairman Clarida, Chairman Alloway, and the rest. So when they're in the Oval Office and they're sitting on the couches and President Trump is going to turn to the people he trusts here, let's start with the Secretary of Treasury. What is Bessent going to say to him about the qualifications needed for a Trump chairman?
Well, probably from Scott Bessent, you would hear the importance of being able to relate on Wall Street. It was put once to me that the Treasury Secretary's job in terms of the markets is to be able to calm them down when something is going wrong. And so that would argue for a certain number of the candidates, maybe Ms. Alloway fits in that category, that have that gravitas to be able to do that. The idea that you want to cut rates is that's not really part of it, because you wouldn't be on the list if you didn't want to cut rates at this point. So it's going to be somebody who is the president will feel comfortable with. Maybe this move, if the Fed cuts rates, he's more comfortable with a wider group of people because he's started to get what he wants.
Add Joe Weisenthal?
We could add Joe Weisenthal because, well, we don't know. If the president is a country music fan, we'd have to find that out first. But I think going forward, the one thing you could say maybe out of this speech is if in an ordinary administration, which wasn't going to be subject kind of the whims the way Donald Trump does things, this would have really given a boost to Chris Waller, because essentially what they're saying is Chris Waller was right that inflation, look through inflation from tariffs because it will be a one-time price boost.
Yeah, now the question's going to be, and ultimately, is this going to be a hawkish cut or a dovish cut in September? PIMCO's Rich Clarida, you've been incredibly generous with your time. Thank you so much for being with us as we dissect that speech. It was a lot longer than his prior speeches, and it was one that signaled the beginning of a new rate-cutting cycle. They have not cut rates since December in 2024. Just to give you a sense of what Jerome Powell had been talking about in that speech, he addressed a number of challenges facing the Fed and his forward projection on policy. Take a listen to what he had to say.
When I appeared at this podium 1 year ago, the economy was at an inflection point. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. There is significant uncertainty about where all of these policies will eventually settle. While the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with policy in restrictive territory. The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
monetary.
This has sent markets absolutely surging across the board in the equity space. Let's take a look. S&P up more than 1.5%, and as Tom was saying, as the session grows on, you see those gains just building. In the bond space, you can see two-year yields plunging by 10 basis points, 10-year yields down by 8 basis points. Again, gaining steam, almost a certainty that they are going to cut rates come next month. Then you have the dollar weakening dramatically. You see the euro now 117.28 as people look to the potential for an ongoing accommodation, even in the face of inflation that is still above that 2% target. This, to me, Tom, really does speak to the moment that we're in. People were expecting that maybe this was going to set the tone, and certainly right now in markets, it is.
Yeah, I have to wait to see what the action is, and the action this morning was to bring in a more accommodative regime. I'm sorry, we still have data coming up, and they may be sobered by the CPI data. I don't have a strong opinion on this, but I got to look at the data. I think I trust the data.
Well, we have two prospective Fed chairs here joining us now, Tracy Alloway and Joe Weisenthal. They also are the co-hosts of Bloomberg's Odd Lots podcast. And I believe you were actually sitting in the lobby, were you not, when we heard James Azora? So what actually happened? Yeah, I mean, this is really a different kind of Jackson Hole that's fraught with that political question.
There's always someone who jumps into the lobby and says something,
Is that really?
This is the tone shift, though, because a year or two ago it was about climate change, and now it's about mortgage fraud.
Yes. No, there is. So now it's like a direct attack of this sort of attempt to maybe like change the composition of the governor. There's always someone who makes a scene, but this time obviously more directed at this impulse coming from the White House about changing the board.
There's also just more security around, which I'm sure you've noticed. Plus, there's more journalists around, which kind of indicates that the story has gotten even bigger.
Yeah, although Tracy, and this is something that I know that we've talked about before, this idea of the economic discussion being so interesting at this moment, whether it's immigration, whether it's what's going on with AI, whether it's youth unemployment. And based on what we heard from that speech, he really was trying to massage that and talk about his concern there.
Yeah, I know you guys were joking about me and Joe running for Fed chair. I'm just going to say right now, I don't want it. I don't want it. This is one of the most confusing moments in economic history that I can remember, because you could make a strong argument either way for staying the course on rates, for cutting rates, or for even hiking rates. We spoke to Kansas City Fed President Jeff Schmidt, and he was talking about how if you look at the Taylor rule right now, the Taylor rule actually suggests that maybe we should be thinking about a hike. I'm not saying you have to stick to the Taylor rule all the time, but it's something to think about.
Pro tip, if you want a good habit as you go into autumn here, listen to Joe Weisenthal's newsletter. You had a newsletter within the last 48 hours. You're talking about a set of narratives forward. Which narrative today won within the Weisenthal newsletter?
Well, look, today is about the short-term cyclical, the short-term question of the cycle. And as Tracy pointed out, I think this is a very interesting moment precisely because there are many people, they're not necessarily saying like, oh, we need to hike right now, but they are saying like, look, there are conditions in which when you look at stocks, spreads, unemployment, and inflation, maybe many people, if this were severance, you're just waking up right now, you'd say, no, we need higher rates. And you didn't really hear that from
Is this a one-off cut that we're talking about, or do we still maintain a Greenspanian anchor where we're going to set up a trend here of rate cuts?
I think the only thing I can say, or that I would feel confident saying in response to this, look, the market does not see a deep cutting cycle, right? I defer to the wisdom of the markets, whether it's 1, 2, 3, whatever, like by and large, this is not a market that thinks there's a ton of room to cut.
Joe's still an efficient market hypothesis guy.
That's right.
Right now I'm watching the crowds gather for the walk that we're expecting when Fed Chair Jay Powell comes out. And we are expecting him to be with some of the other international leaders. And we were talking about the international tone here at this particular Federal Reserve confab. How much does that really influence, do you think, the message that we're hearing from the U.S. Central Bank?
I mean, I think Powell has to walk a really fine line here where he's clearly paying attention to the U.S. domestic economy. That's the mandate, the dual mandate, right? But on the other hand, you do have other central bankers here. And as everyone knows, when the U.S. economy coughs, the rest of the world catches a cold and all of that. So it's a fine line. It's, a diplomatic exercise in many ways.
I also think, if there are questions about Fed central bank independence, or central bank independence at the Fed, there's going to be questions everywhere, right? Like the U.S. is like, you would think, like sort of the gold standard globally for like a good institutional arrangement and so forth, and aspired to by many places elsewhere. Like if this is an important debate here, it's going to be an important debate everywhere.
This actually was the reason why Joachim Nagel really got emotional actually talking about this, and really was focusing on how the United States allowed Germany to follow the mold of an independent central bank, which allowed it to emerge from World War II with a currency and with an economy. I mean, that to me is really this ultimate key question. How much does a loss of independence, or even perceived loss of independence in the United States, really trickle out into central banking policy around the world?
Well, I think the difficulty is no matter what they do now, there's an optics problem. Even if Powell really convincingly feels that he should be cutting rates, there are going to be some people who say, like, well, maybe he felt the pressure from Trump, and so he's sort of doing it because of that reason. Central bank credibility takes a long time to build up, and you could argue the Fed has been building it up basically since the 1980s now, since Volcker. It goes away really, really quickly.
It goes suddenly. Suddenly is the operative adverb. Now, you guys spent August in Alaska, and the rumor is you're heading for Japan. Is it September or October?
No,
we're going to get the walk
we're making stuff up here.
And the guy with the biggest headache at the walk right now is Ueda of Japan, if he makes an appearance. I just looked at the Bloomberg, folks. The magic of the Bloomberg on your cell phone is when you need to look at the 20-year Japanese piece, you can look at it. Tracy, nobody's talking about this. Yields unraveling, price down, yields up in Japan. What does that signal to the international central bank community?
I mean, I'm still kind of surprised that Bessent was jawboning the BOJ recently. Like that to me is like a new angle in politics meets central bank policy. That's all I'm going to say.
I just say, look, you look at the last 5 years, there's a global factor to all of this. Inflation rose and fell everywhere, and to like varying degrees, et cetera, but almost every, especially developed market government, is essentially dealing with the same set of questions all in unison. There's slight changes at the margin. Inflation peaks a little lower here, a little lower there, but all of these stories are really global stories, the entire like sort of developed world.
Can we talk about investment in America? Give me the wide shot right now, if you would, if anybody's still awake in the tent. Give me a wide shot here. And the most important thing here at Jackson Hole this year, besides Chairman Alloway, is the split rail fence behind us, of which the leaders of central bank world are going to walk up to next. We have an investment in a brand new split rail fence at Jackson Hole. The last one was installed by Lewis and Clark a few years ago.
Thank you for this breaking news, Tom. This is really definitely the way to go.
But this again is the investment of America that you're going to see. We have a spanking new fence.
Yeah, and it's going to generate energy for all of the power centers that we have to try to generate II. That's what
I know this is kind of a joke, but I think this is an important point here, right? Because I was, one of the questions I've been asking, like we've been asking lots of people, it's like, okay, 2025 versus 2019, why is that long-term rate higher? Why did market expect? There's just a lot of investment going on globally. Part of this like reshoring impulse, et cetera. And so I think, I think we should take the split seriously.
There's capacity issues as well, right? And the thing about this Jackson Hole is it resembles the 2021 Jackson Hole quite a bit. I think you were both there at the time. You remember the argument back then was, okay, pandemic supply chain issues were going to be transitory. We don't expect them to feed into services, inflation, just goods. You're hearing something very similar right now when it comes to tariffs, right? Like we think tariffs are going to be a one-time price level change, just isolated in goods, probably not seeping into services. I guess we'll see.
Well, to me, this is the key question. How much were people scarred by transitory? And it seems like maybe not so much.
So inflation is all top of mind for all of us, right? Think back to 2020. We hadn't seen interest rates like much above zero for years and years and years. We all remember inflation now. I'm sure a bunch of companies remember the inflationary playbook now. So,
indeed, which is the reason why potentially they could adjust and adapt and keep prices going higher. Tracy Alloway, Joe Weisenthal of Bloomberg's Odd Lots podcast. Thank you so much, both. And just for the record, Tracy is not in the running for a Fed chair. Well, she just said she doesn't want it. So there we go. Exactly.
Go for it,
there we go. So Joe is going to run himself. Right now, let's take a look at markets because it really has been a dramatic move. We have seen equities across the board shooting higher. The Russell 2000, let's just focus on that, up 3.9.
Right. Um, so a few things here, right? So right out the gate, for those that are um, holding on to those bond funds that we picked up, we started picking up, as rates kind of peaked and started to roll over from there. Check those bond funds today. You should be getting a nice solid bump in your bond funds today. And of course, as you can see, the stock market is definitely making a little push. That you can see the SPY just ever so slightly hit a new high today, I believe. Let me see. So we got 646.19, and then we got 646.27. So yeah, so we just ever so slightly hit a new high today. We did say we could be headed towards the 650s area. So we'll see if we can get up there or not. Two standard deviations in that regard, like 652 80 652.82, right around that area. So we'll see if that's where we're headed at the moment. Um, so big day for bonds, big day for stocks. Um, of course, I'm gonna be maintaining my VIX positions. I'm gonna let those sit. So we're not gonna do anything with those there. Um, I think that early spike in that 55 strike, as we saw the market start to as we saw the market start to react to the fact that Jerome Powell was coming on. I think that was a early sign that those 55s are going to pay off, in the long run. Um, so definitely holding on to those. Um, I thought what was interesting recently, the conversation about the Taylor rule. For those that aren't familiar, it's basically just a formula. That's all it is. Just a formula, similar to the Saturn rule, right? It just says, hey, here's where interest rates should be, based on X, Y, Z. I'm not sure I see how it's supposed to lead to a rising in interest rates. I haven't done the math. Um, you know, but I don't know. I'm kind of. I guess it would be if inflation was to pick up further from here. So I would say yes, of course. If inflation picks up further from here, then the Taylor rule would probably suggest that we should be at 4.5% instead of 4.25%. I think that's probably what they're talking about. Um, so we'll just have to continue to watch, wait, and see how. We'll just have to continue to watch, wait, and see how tariffs play out on the inflationary front. We are seeing more and more businesses, small and large, saying, "Hey, we're gonna have to raise these rates, right?" Um, if we can get towards this 650 area that we're talking about, and I mean, it could be more so wind than anything now that we've seen this response here, but we gotta wait to the end of the day to see how we close out, right? But um, if or when we get to this other end here, and you know what? One thing I did notice, right, is that we got one take profit here, one take profit here. We never got that third. As far as the latest long position that came back here. So maybe there is one more standard move higher for us coming, and maybe that'll be a more defined moment, where we can sort of see what's left in the tank from there. Now, as I was saying, I know yesterday, when we were talking, I think it was either yesterday or Thursday. I did point out all the stocks in the index that was undervalued at the time. I don't know if anybody picked anything up. And I did not, all right, because you guys know how I am. I'm just gonna let whatever stocks that I have continue to enjoy the gains there, and I'll wait to put more money in that side of the market, whenever whatever kind of correction it is that we see or anything of that nature, right? So we'll certainly be looking out for that. Still don't believe we're headed to an entirely new stratosphere without some sort of a correction in price. And even as you see these different companies and how differently they respond to how differently they respond to earnings reports and stuff like that. I think it's pretty clear that um, over time you start to see a varying response on earnings reports. So we'll see how long that continues to push things higher and stuff like that. We have most of the returns being pushed by the smaller group of companies there. Even on a day like today, I think Nvidia's up like 1.8%, Intel's up like 4% and stuff like that. So you have let's go back over here. I have it open over here. There we go. So you can see here, pretty big day for certain companies here, right? Financials are doing well. Berkshire just can't catch a break. Um, you know, Here we go. Healthcare. These drug manufacturers are not getting a break here. Defensive, kind of dialing back there today. But you got Tesla up 5%, Amazon up 2.5%, Broadcom up just about 3.3%. Nvidia a little less than 2%, Microsoft up 1.12%, Palantir up 3.9%. I know some people that are going to be really happy with some of the decisions that they've made over the past couple of days. Specifically, um, you know, um, recently picking up some Microsoft and things of that nature. Um, so I'll be talking to them later on this evening. I'll see how they feel about that. But either way, like I said, so we'll just be watching here towards the end of the day, and if we close the end of the day strong, um, you know, definitely. There's always going to be a possibility to like revert a little bit because of the size of this the size of this candle today. If we close near the highs, it is possible that you'll get like a reversion a little bit there. And you want to stay you know above these key levels as you see any kind of reversion or pullbacks or anything like that. So let's see how we close out today, man. Then if we go into as we go into to power hour, we'll be able to make any determining factors with do we take some longs tomorrow or anything like that. That'll be some great stuff. Let's check really quickly before we close out. Let's check really quickly. So you can see here, your put the call for today is, the volume is through the roof here. You got to wonder, are these people closing outputs, right? Or are these people, or are these people actually, um, you know, uh, are these people closing outputs, or are they actually adding more to their put positions. Let's take a look at, let's go to the options flow real quick here. Matter of fact, this is one of those times where I actually will go to the unusual options. I don't go here often, but let's take a quick glance here, right? Hmm. Now we don't want to look. We don't want to be looking at these too much of these here for the day, right? So like on the 25th, so you can see, well, pretty much like um, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Should we keep counting? Yeah. Even the top 20 positions here, as far as like as unusual options activity is concerned. Specifically for August, look at this one for August here. I see, like so I'm giving you guys some insight here. On a day like today is a better day. Like if I want to look at unusual options activity, I don't do it every day. But on a day like today, I will take a glance at it. And I'm seeing right here, um, I mean, for the 4:30 and 5:30 puts for October 31st. That's crazy. 100,000 contracts uh, on each one of these. Then the 645 put 75,000 contracts for August for today. So I guess somebody I don't know, I guess just be close below this. I don't know what that one is. That's why I don't like looking at the ones that are expiring today. They don't give you much insight there. So I kind of just looking right here. 644 to September 3rd. All right. 644 for today again. That's 91,000 of those. All right. 612 for September 19th. Open. Largest contracts 480 for October. 1,000 here. Overall, though, the delta imbalance is to the upside. It is positive, um, slightly at least. So it's more of a neutral. Like we're like more like smack in the middle, on the delta imbalance. What about it's about $8 million net trade settlement here. So slightly tilted to the upside on that particular note there. So um, so I'm gonna, like I said, I'm still gonna give it through the end of the day to see how we're closing out. But definitely will not let it go unnoticed here. That definitely will not let it go unnoticed here. That the how do I put it? So we're definitely seeing yet again a lot more positioning going on here. Now today the commitments of traders is coming out, so I'll have a look at that this weekend, and we'll discuss that on Monday to see how that ends up playing out. But I think next week's report will be even more important because it'll be following today's developments, and then we'll see. Well, how do speculators and institutions position themselves following this this development here, right? So that's going to be a really conversation. They got Jerome Powell walking out right now. He's just now leaving. Jackson Hole is that? Oh, never mind. He's with the ECB president as well. So, anyways, like I said, man, bonds are up. I'm liking the way my bond portfolio looks today. Um, Stocks are up. I'm gonna enjoy those gains. Gonna hold on to my VIX positions, not letting those go. And then we'll go from there. All right. Other than that, all right. I'll catch up with you guys at 3 p.m. All right. Everybody be blessed. Stay well, and I will talk to you soon. Later, guys.